I'm Prieur Plessis, and I've just addressed a Leader's Angle presentation on the topic of investment perspectives in an uncertain world. We're faced with possibly an unusually uncertain investment environment, and the thrust of my discussion was to cast some light on how one should define how one should construct investment strategy in this specific type of environment. An edited version of my presentation follows. And this is really what the talk is all about, to discuss investment perspectives in a very uncertain world, an environment that's recently, just a few days ago, been described by Ben Bernanke, the chairman of the American Central Bank, the Federal Reserve Board, as unusually uncertain. Let's then consider the outlook for the global economy, and there'll be a specific emphasis on America because the American situation is perhaps key to what happens elsewhere in the world. We'll go back to 2000, 2001, when there was a mini recession in America. The policy action pursued by Alan Greenspan, chairman of the Fed at the time, was to drop interest rates. Not only did he reduce interest rates quite dramatically, but he then kept rates at a very low level, at that 1% level, for an extended period of time. As a matter of fact, rates were at artificially low levels because they were lower than the rate of inflation. And this was the same as handing out gifts to people, handing out free money. And we know what happens when you get undeserved gifts. You squander them. And the rest, or let me just firstly also refer to what Paul McCulley said about that. When the Fed is the bartender, everybody drinks until they fall down. And the end result was a credit crisis followed by a global economic recession. What we have today is a massive deleveraging of balance sheets across the world. We've seen unprecedented central bank action regarding monetary policy. We've seen numerous bailout or fiscal stimulus packages. And also, we're moving from a situation where there was an inflationary threat to disinflation and possibly even about of deflation. The whole question of debt is dominating the situation today. This is a very interesting website, the US Debt Clock, which updates from minute to minute, and it shows debt at all different levels in America, and the important number is that one. Total US debt, 54 billion. Now, to put that in context, the size of the economy is about 13 billion. This graph is slightly out of date. Debt expressed as a percentage of GDP is now in excess of 400%. In order to gain some perspective of the quantum of what we're referring to, this block indicates the size of 50 billion US dollars. Now, to look at some large ticket items in history, the war in Iraq probably makes up about 16, 17, 18 of those blocks. In other words, approaching $1 trillion. And similarly, we can have a look at a couple of other examples going back. But on the left-hand side, we have these bailout actions. Take, for example, Fannie Mae, Freddie Mac, the mortgage companies in America. And you can see this simply dwarfs anything else we've seen previously in history. This is a tool used by the New York Fed a recession probability model. It's based on the yield curve, in other words, the difference between long bond rates in the States and short rates. This seems to say that the chances of us going back into a recession are less than 1%. That's on a 6-month horizon. To summarize the economic outlook, we're seeing that global economies are recovering, but the upturn is subpar. I've referred to the disinflationary impact. It is possible that policy might have to be eased further at the very least, and I think this is key as far as investment strategy is concerned. Interest rates will have to remain low for many years, especially as these austerity packages start coming into play, in other words, as the fiscal stimulus start fading. So on to the question of the shape of the recovery. I've already referred to slow growth, subpar growth. Typically people will question whether it will be a V-shaped, a U-shaped, a L-shaped, or even a J-shaped recovery. That's the one I think we're going to see, and that's the one business and investors will have to adjust their strategies to. In other words, a slow bottoming out process. On to the South African economy, and I'm going to flip through the charts rather quickly because a lot of thinking is quite similar to what I've been through when discussing the American economy. When looking at GDP growth, again with the leading indicator, a similar situation to that we've seen in America. In other words, there is a recovery, but a slow recovery with that leading indicator stalling. Exports, with the pickup in global economic growth, exports are recovering. Of course, the strong rand plays a role in holding back here. The situation of unemployment, we have high unemployment throughout the world, but in South Africa, and I don't need to say very much about this, we're at particularly high levels, and to really exploit the full growth potential of the country, this is a matter that will deserve very, very serious attention. As far as the rand goes, the rand's been strong, but the rand's not the only currency that's been strong. Emerging economy currencies as a whole have experienced strength. To summarize the South African economic situation, we're projecting a turnaround, but again, it's the new normal type scenario that we're referring to. In other words, slow growth, subpar. So on to global stock markets, and I'm again going to start with the American market, where we've seen a huge roller coaster ride. Firstly, the sharp declines at the time of the crisis, and then a significant recovery subsequently. Two interesting observations I'd like to make on this chart, and the first one is that the level where we are at the moment, and I'm looking at the Standard & Poor 500 benchmark index in America, is a level where we were also back towards the end of the previous big bull market in 1998. So somebody who invested in 1998 would have seen 0% capital growth. Of course, there would have been dividends, but no capital growth. On the slide, I have performances for the year to date for a number of different asset classes. And we can see the Standard & Poor 500 index, a return of just about zero. Similarly with emerging market equities, commodities, a negative almost 7%, and just more than 3%, rather 2% down for oil. Then the so-called safe haven assets are the ones that have been performing. Bonds that I've referred to earlier on, almost 10% higher. The US dollar, positive return, and also gold. Now, the issue of whether we're in a bull market or a bear market, the so-called 200-day moving average is used as a guideline In other words, if more stocks trade above the 200-day moving averages, it's seen as positive, bullish, and the other way around. At the moment, we're at 55% of the stocks being in a bull market. So not unlike that rate of change indicator I've referred to previously. Bullish, but barely so. The key to what will happen with stock prices, I believe, is the whole question of earnings. Earnings, again, dependent on economic growth. I've summarized this in one sentence, saying that in the short term, the stock market is a beauty contest, and it may very well be Google or Apple or some flavor of the month stock doing the running. But over the long term, it's a waiting machine. Playing the waiting machine's metric is earnings. What counts in favor of stock prices, as far as the foreseeable future is concerned, is the easy money policy. As we see from the yield spread, a positive yield spread is conducive to stronger stock prices. So this will probably provide some support to the market. I'm not arguing that the market is going to fall away, not by a long shot. I'm just arguing that returns on average are going to be not particularly exciting. But there is an exception, and that's emerging markets, where emerging markets in terms of price earnings valuations are now trading at a discount to mature markets. Keep in mind, these are the fast-growing economies. These are the less indebted economies. So on to South Africa. And I'll just flip through because we come to pretty much the same conclusions here. That's a chart of the JSE All Share Index. We're not very far off the highs that we saw prior to the crisis. In terms of the number of stocks trading above the 200-day moving average, again, a similar picture. We're at about 60%. In terms of earnings, again, a leading indicator that shows that earnings should be going up. Analyst forecasts are for all share earnings to improve by 40% over the next 12 months, with resources going up 70% and other components growing by a little bit less. Looking at returns, here we don't deal with normalized earnings. We simply don't have a long enough history to properly research this. So we're referring just to the normal historic price earnings multiple. We're at 17 at the moment. When we factor in earnings, we'll probably lie somewhere between the two there, which implies returns, real returns over the next 5 years in this case, of about 4 to 5%. Not too shabby, but less than what we've become accustomed to. So, pulling all this together, I'll attempt to answer the question, which asset class do we invest in? What I have on this slide is a number of different asset classes, and then a system, some symbols, in terms of which we have 2 green dots showing very positive, going to 1 positive, neutral is yellow, and then the red ones on the other side. So considering equities, we firstly have all the different South African equity indices. We're neutral. This is just considering the market as a whole. Going to mature economies, we're neutral as well. On gold, I'm reasonably bullish. Just to conclude with 1 or 2 quotes, Warren Buffett, well-known chairman of Berkshire Hathaway in America, said, I have no idea what stock markets are going to do tomorrow or next week or next month or next year. But over a 10-year period, you will do considerably better than owning a group of equities than you will do owning treasuries. In fighting the economic war, we've taken action that sows the seeds of substantial inflation down the road. Not in the next 6 months or year, but 10 years from now, the dollar will buy a lot less than it buys today. Jeremy Grantham, equally well-respected investment manager in America, the recent rally has been very speculative, favoring risky assets over the past few months. I'm sorry if you missed investing at the market's lows, but don't compound the damage to your portfolio by chasing gains in risky assets. We're at the beginning of a 7-year period of lean returns. Again, the new normal type scenario. You should only be buying the highest quality blue chip companies where valuations are most attractive. The whole question of stock picking, good old-fashioned stock picking coming back into favor. So I'll leave you just with one thought, and that is that the focus should be on the return of capital, in other words, wealth preservation, rather than the return, striving for the maximum, shooting out the lights return on capital. That is the end of my presentation. Thank you very much.